Welcome to Details in Divorce, where we break down the legal, financial, and emotional aspects of divorce to help you make informed decisions. I'm your host, Paul Riley, and each episode we dive into key issues impacting individuals who are navigating separation and divorce. So if you're concerned about asset division, protecting your business, or dealing with foreign property disputes, we're here to provide clear, practical insights. Now, divorce is complex, especially when you're a professional with a corporation. But understanding your rights and options can, in fact, make all the difference in the world. So if you're a doctor in Ontario who's tucked away real estate profits or run your clinic through a professional corporation thinking it's untouchable, well, you better think again. Now, this isn't legal advice I'm giving you. It is designed, however, to empower you with knowledge that you may need to navigate these high-stakes situations with clarity and confidence. Today, we're diving into the illusion of corporate protection in divorce and how Ontario courts pierce through corporate structures to get to the real value, whether it's for equalization or support. We'll look at what the law says and what the courts do and how real cases have played out. Now, there's a persistent myth in the world of high net worth divorces. If it's in the corporation, it's untouchable. Well, that couldn't be further from the truth. Under Ontario's Family Law Act, Section 4.1 specifically, the definition of property casts a very wide net. It includes any interest, present or future, vested or contingent in real or personal property. In Abbott-Ball v. Abbott-Ball, a 2020 case, the court held that business interests, whether that's paralegals, contingency fee contracts, medical practice, or a book of business, they can all be included in equalization or net family property. In the case of Kara v. Guman, for example, Dr. Guman, an orthodontist, denied owing any equalization. He argued that his wife, Ms. Kara, actually owed him. On the date of separation, he held a 100% interest in Guman Dentistry Professional Corporation. He owned 50% interest in two other clinics as well. The only major issue in this case was valuation. That is to say, what were these interests actually worth? Well, the court followed the Supreme Court of Canada's three-step equalization framework. 1, determine ownership interest. 2, complete the equalization calculation. And 3, assess unconscionability under Section 5.6. In this specific case, the court subscribed to the discounted cash flow analysis that was provided by the wife's business valuator. The business valuator factored in the associate fees at 20% of collection and applied a 2.5% disposition cost as well. The final valuations included $305,000 for Guman Dentistry, $580,000 for his interest in another dentistry, and yet $95,000 more for his piece of another company he owned in Brampton. The bottom line here, courts can apply sophisticated valuation models and won't rely on your say-so. Going back to Abbott-Ball v. Abbott-Ball, Mr. Abbott-Ball, a paralegal, had contingency fee contracts with WSIB clients. He argued that they weren't property. The court, however, disagreed. Contracts acquired during marriage entitling a professional to future fees are, in fact, assets. The court found the contracts were like accounts receivable and must be included for equalization. The case underscores that recurring revenue, even if contingent, is property under the Family Law Act. In Vora v. Vora, Dr. Vora left $1.8 million in retained earnings in his professional corporation and argued that only his T4 salary should be counted for support. His wife disagreed, and in that case, the court held that retained earnings and shareholder equity must be reviewed to determine true income, especially when business and personal lines blur, such as the corporation owning the family home. In cases like these, expert reports are essential. The bottom line, in this case, retained earnings aren't invisible. In NRIH v. MG/SH, Dr. H drew salary from her corporation and withdrew funds for personal use, creating a shareholder loan. In this case, the court accepted that retained earnings could be paid out as dividends or salary, each with tax consequences. Now, while the accountant, in this case, didn't testify, it was agreed that figures accepted were used and calculated to determine the business value. All right, so what's the lesson here? Courts will account for retained earnings, loans, and tax implications. Your accounting structure doesn't shield income from scrutiny. Professionals often miscalculate risk, such as the common errors that include 1. Assuming that corporations are untouchable, not the case. 2. Blending business and personal expenses. And 3. Skipping formal business valuations. But Ontario courts understand corporate finance. They know where to look, and they're not shy about assigning value. If you're an incorporated professional in a marriage or common law relationship, here's what you should do now. 1. Draft a marriage contract without delay. 2. Commission a proper business valuation before there is conflict. 3. Separate personal and corporate transactions. 4. Track shareholder loans and dividend decisions. And 5. Talk to a family lawyer before assuming that you're protected. Well, that's it for this episode of Details in Divorce. We hope you found today's discussion insightful and valuable as you navigate your own divorce journey. Remember, every situation is unique, and getting the right information is key to making the best decision for your future. If you have any questions or need guidance, the Riley Firm is here to help. Be sure to subscribe so you don't miss our upcoming episodes where we continue to explore the critical issues that matter most during divorce. I'll see you next time.